Hi folks, when it comes to wealth creation, investing and trading are both very different methods of attempting to gain wealth in the financial markets. Imagine two friends signing up for a marathon. Investing is friend A, who jogs at a consistent speed all the way to the finish line, while trading, friend B alternates between walking, jogging and even sprinting. While this may be a colourful example illustrating the difference between investing and trading, it highlights the different approaches used to reach the finish line. In this instance, profiting in the financial markets. So what is investing? Well, in this context, investing involves buying financial instruments. For example, you invest in your favorite stock and holding it for an extended period of time with a goal of long-term gains. This takes a longer-term approach to the markets, with investors more concerned with market fundamentals like a company's recent revenues or major developments concerning the company. An example could be Apple, which recently unveiled a new MacBook Pro model. Such a development is likely to boost confidence over the company's business outlook, with the possibility of increased sales being reflected in its next earnings report. If earnings beat expectations, this could lift the company's stocks higher. One thing to keep in mind is that the time horizon of investment will depend on the investor's financial objectives. For example, someone who is investing for retirement may have a time horizon of 10 years plus. Alternatively, someone who is investing to buy a car may have a horizon of 5 years. Even in the realm of investing, there are two different styles. We have active investing and passive investing. So active investing is the technique that involves the investor to actively buy and sell financial instruments in their portfolios, while passive investing involves buying a fund that aims to track the performance of a particular index. Now let's talk about trading. So compared to investing, trading involves more frequent transactions such as buying and selling of commodities, currency pairs and other instruments. Traders may also buy and sell a CFD, which stands for contract for difference, a type of derivative product that you can use to speculate on the future direction of a market's price. Trading is more active and short-term, focused with the goal of making quick profits. Unlike investors who measure their horizons in years, traders work in terms of weeks, days, hours, and even minutes. There are different types of trading styles ranging from position trading, swing trading, day trading, and even scalping. The position trader holds financial instruments for months. A swing trader may hold for weeks, while day trading throughout the day but not overnight. In regards to scalping, financial instruments are held for minutes or even seconds. So what are the differences? One key difference already highlights the time frame. While investors invest their money for years, traders hold positions for a short period of time. Capital growth is another major difference. A trader observes movements of stock CFDs in the markets with the intent of possibly selling or buying. On the other hand, an investor creates wealth by holding quality stocks that appreciate over time in the markets. Let's not forget about risk. Undoubtedly, both trading and investing have its risks of losing capital. However, trading involves higher risks and potentially higher returns in a much shorter time frame than investing. An example may be an investor who purchases a company stock that rises 5 to 10% a year on average. The main risk the investors will face will be the market risk, in which the whole market declines in value, and specific risk to the particular stock. Unlike an investor, a trader may be aiming for 10% a month, which may involve higher risk, but potentially higher reward. Traders face volatility risk associated with price fluctuations and leverage risk, which can increase profits, but also magnify losses. Lastly, investors focus on fundamental analysis, while traders tend to focus more on technical analysis. This could be a conversation for another time though. So investing versus trading, which is better? Well, do you remember early on we compared investing and trading to two friends in a marathon? Just as it was hard to predict who will win the race, much like it's difficult to say which approach between trading and investing will benefit a person the most. Ultimately, which strategy will suit you may be influenced by your financial objectives, risk tolerance, understanding of the particular market, and amount of capital you have to get the ball rolling. If you haven't watched my last video on Save It or Invest It, do take a look as I briefly spoke about investment capital. Remember to like this video and subscribe to our YouTube channel for all things markets. Until next time, thank you.